Hello, guys. Welcome back to Zodiac Trader. So, today in this episode, we are going to start a new series. It's about option trading. So, we're gonna have beginner, advanced guide for all the viewers. So, I'm trying to simplify all the important concepts and try to break down all the fundamentals. So hopefully, you guys can learn it quickly and be able to trade options. So today, in this very beginning of the episode, we will talk about options contract. So there are different contracts. We're talking about um, American contracts, we're talking about European options. There are many different contracts. So, the definition of option is a contract between two parties, a buyer, also known as the long position or holder, and a seller, also known as the short position or the writer. So the contract gives certain rights or obligation to buy or sell a specific or specified amount of an underlying assets at a specified price known as the strike price or exercise price within a specified period of time. The buyer has the right but is not obligated to exercise her contract, which seller is obligated to fulfill his part of the contract if he called upon to do so. So there are simple examples for options. So for example, when you go to buy a car, there's a chance for you, like for the car seller, to doing all these promotion with like limited time promotion. For example, like 80% off or 90% off. But you have to pay, for example, like 1% of the total price to actually book the car. That gives you the right to actually get that special discount. And for that payment, that gives you the right to actually exercise to purchase the car with 80% or 90% off of the car. So basically is a better price. But if you can choose to exercise the right, if you can wish to purchase the car, or you simply would like to cancel the purchasing, but you will end up losing the option value. But the car seller, it is the car seller's obligation to sell you the whole car with discount as as promised. If it doesn't give you that discount, it will commit the fraudulent. You also commit crime. It will subject to the federal law. So in that case, the car seller is the option writer. It sells you an option which gives you the right to execute the car with the given price with promotion. So in this case, the option buyer is the car purchaser, is the consumer that looking to buy the options with premium, which is the 1% of the car value in order to secure the obligation of purchase the car with discount. So that is basically a very simple analogy for options for both sides. So for the right to buy or sell the underlying assets, option buyers must pay sellers a fee known as the option price or option premium. So in our case, what you have paid, that 1% of the fee that helps you secure the car price with promotion, that could be called as option premium. So if you regret, you do not wish to purchase the car, and you regret, and you can what's going to happen is you're going to lose the option premium. You're going to lose that 1% of the total value of the car. So that would be the option price or option premium. So upon payment, the option buyer has no further obligation to the writer unless the buyer decides to exercise the option. Thus, the most that the buyer of an option can lose is the premium paid. So option writers must always be ready to fulfill their obligation to buy or sell the underlying assets. So as the evidence of constant ability to fulfill their obligations, writers of exchange-traded options are required to provide and maintain sufficient margin in their option accounts. Writers of OTC options typically do not have these requirements. An option that gives its holder the right to buy and its right and obligation to sell the underlying asset is known as a call option. So an option that gives its holder the right to sell and its writer the obligation to buy the underlying asset is referred as a put option. So there's another example for writing options or option seller is the insurer. So when you go for insurer, you pay for the insurance. The insurance company, as an insurer, which is the option writers, is obligated to give you or to fulfill their obligation. Say if something that happens to you, maybe a car crash, maybe a sickness or disease or etc., or maybe an insult, you can go to the insurer and get the insurance funds. So it is the insurer's obligation to fulfill that duty, that obligation, because you have purchased the insurance services you have purchased via the option premium. So that is a classic example of an option seller. So an option seller is like an insurer. So whenever you are thinking what could be option writers, the very, very direct example that you will be thinking about is the insurer. So you can buy an option, which is you can buy a call option. That means you'll be able to, in the car analogy I was talking about, you'll be able to buy the car with 80% off discount. Simply saying you are buying a call option of that car. So an option also gives the holder the right to sell. So the put option, you can also put an insurance on that car. Say, for example, if the car is getting hit and the car is getting damaged, you have someone else is paying. You have someone else is going to pay for your losses. We call this puts. In some case, you can buy the put option to protect the assets. Okay, so there are different examples as we will explain further. So the rights and obligations associated with option positions. You have call option, which is the buyer or holder. That means you're paying for premium to the writer for the right to buy the underlying assets. Or saying you're a writer or seller, you could sell call. That means you can receive premium from the buyer and has obligation to sell the underlying assets if called upon to do so. Remember the car dealer example. So put, the buyer or holder, you could pay a premium to the writer for the right to sell the underlying assets. Okay, so you can also receive premium from the buyers and has the obligation to buy the underlying assets if called upon to do so. So when you are buying put, you're actually buying for protection. When you're selling put, you're trying to sell a insurance to someone else. So as an insurer, you have the obligation to fulfill. So here as the syntax to describe an option. So here's an underlying assets, expiration month, strike price plus option type. So you will hear a lot of complicated jargon like buy 10 XYZ December 50 calls. Okay, so I don't expect you to understand immediately, but given some time, you will get used to the way it is because we option traders use it like on daily basis. We say buy 10 APPL, for example, like November, 120 calls, etc. So there will be other jargons in the future. We will be talking about it. So same as buying a stock. The investor would also indicate the price at which he is willing to pay. So he could purchase at market, in which the case he agrees to accept the best price currently available. Or he could enter a limit order by specifying the highest price at which he is willing to pay. So options, the trading units describe the size or amount of the underlying asset represented by one option contract. So most of the stocks options, they are just representing 100 shares. As you can see here, all exchange traded stock options in North America have a trading unit of 100 shares. Thus, a holder of one call option has the right to buy 100 shares of the underlying stock, while the holder of one put has the right to sell 100 shares. So the premium of an option is always quoted on a per unit basis. For example, the premium quote for a stock option is the premium for each share of the underlying stock calculated by multiplying the premium quote by the option trading unit. So if a stock option is quoted with a premium of $1, so it will cost the buyer $100 for each contract. So, as I have mentioned before, there are different contract style. There are American and European style of option contract. So there are different way of exercising. There are different timing of exercising. So we can take a look at the American style option. So the options that can be exercised at any time, up to and including the expiration date, are referred as American style options. It's very easy to understand because it's more flexible. So the options that can be only exercised on the expiration date are referred as the European style options. So European style option is less flexible, so it's more static. So you have to be really careful when you start picking the right contract for European style options. So traditionally, options have been listed with relatively short term of 9 months or less to expiration. But there are exchanges that have listed options with longer expirations, such as 2 to 3 years. These are called long-term equity anticipation securities. We call this LEAPS. So LEAPS is a bit complicated derivative. So the LEAPS are long-term option contract and offer same risk and reward as regular options. So if you're willing to give some time, you could potentially buy a LEAP. So for option transactions, establishment of a new position in an option contract by an investor is referred as opening transaction. So an opening buy transaction means results in a long position in the option. So the opening sell transaction results in the short position in our option. On or before an option expiration date, one of three things will happen to a long and short option position. For exchange traded options, positions may be liquidated prior to expiration by way of an offsetting transaction, which in effect cancels the position. Offsetting a long positions involves selling the same type and number of contract, while offsetting a short positions involves buying the same type and number of contracts. So OTC contracts can be offset by negotiation. This is how, when you start your trading account, say your option trading account, this is how you open a long position and you open a short position and how you close both positions accordingly. So you should keep this in mind. So the party holding the long positions can exercise the options. For example, the party holding the short positions is said to be assigned on the option. For the owners of call options, the act of exercising involves buying the underlying assets from the assigned writer at a price equal to the strike price. For the owners of put options, exercising involves selling the underlying assets to the assigned put writer at the price equal to the strike price. So when you are selling a call, you're expected to buy the asset back. So when you're selling a put, that you are expected to sell these assets with the given strike price. So parties holding a long position can let the option expire. Buyers of options have the rights, not obligations. If they do not want to exercise their options before they expire, they don't have to. It's a right, not an obligation. So the example is still the car dealer example. I mean, as a consumer, you can always revoke, you can always regret. Say you don't like the car, so you cancel, you cancel that trade. So the price you're gonna give is the premium because you still needs to pay that 1%, and you cannot take that money back because you forsake, you have given up the chance to exercise the right of buying a car with the given price. So that's the concept. So you, as an option buyer, you always have the chance to give up. So the party holding the long positions can exercise the options. For example, the party holding the short position is said to be assigned to on the option. Okay, so that is very important. Before you trade, it's best for you to understand the definition of exercise and the term assigned. So as a contract holder, as an option buyer, you can exercise the option. As the interest seller or as the option writer, you have to be assigned on the option. So the owners of options will exercise only if it is in their best financial interest, which can only occur when an option is in the money. We will talk about the definition of in the money here. So a call option is in the money when the price of the underlying assets is higher than the strike price. If this is the case, the call option holder can exercise the right to buy the underlying assets at the strike price and then turn around and sell it at higher market price. So a put option is in the money when the price of the underlying asset is lower than the strike price. If this be the case, the put option holder can exercise the right to sell the underlying asset at higher strike price, which would create a short position and then cover the short position at the lower market price. So the in the money portion of a call or put option is referred to as the option's intrinsic value. So for example, if XYZ stock is trading at $60, a call option on XYZ stock with a strike price of $55 has $5 of intrinsic value. Similarly, a put option on XYZ with a strike price of $65 has $5 of intrinsic value. Thus, intrinsic value of an in-the-money call option would be price of underlying minus strike price, which means $5 equals to $60 minus $55. So the intrinsic value of an in-the-money put option would be strike price minus price of the underlying. That means $5 equals $65 minus $6. So if an option is not in the money, it has zero value. Okay, say If this is a out of money option, the out of money option has zero intrinsic value. So for example, a call option on XYZ with a $65 strike price has no intrinsic value, as does a put option with a strike price of $55. So here we talk about time value. Time value is really important when it comes to options trading, because you want the time to you want the time to be on your side, because when you are longing an option, when you're option holder, time is against you. When you're selling that option, time would be your best friend, because longer time means longer the option premium received. But for option holder, you are expected the option to be exercised, to be exercised with the given time. So time could be your enemy. So prior to the expiration date, most option trade for more than their intrinsic value. The amount by which an option is trading above its intrinsic value is known as the option's time value. For example, if a call option on XYZ with a strike price of $55 is trading for $6 when XYZ stock is trading at $60, the option has $1 of time value. So time value of an option equals option price minus option's intrinsic value, which is $1 equals $6 minus $5 equals to 1. So rearranging the equation, that means option price equals to intrinsic value plus time value. So here we learned about intrinsic value and time value. Intrinsic value is the amount that the owner of an in-the-money option would earn by immediately exercising the option and offsetting any resulting position in the underlying assets. Time value represents the value of uncertainty. So options buyer want options to be in the money expirations. Option writers want the reverse. The greater the uncertainty about where the options will be expiration, either in the money or out of money, the greater the option times value. So out of or at the money options. So owners of options would definitely not exercise if they are out of the money or at the money. So a call option is out of money when the price of the underlying is lower than the strike price. A put option is out of money when the price of the underlying asset is higher than the strike price. A call and put options are at the money when the price of the underlying assets equals to the strike price. If a call option is out of money, it does not make financial sense for the call option holder to buy the underlying asset at the strike price by exercising the call, and when it can be purchased at the lower price in the market. Well, I mean, like if you're a big money spender, it doesn't really matter. So out of or at the money option, still you see here, if a put option is out of money, it does not make financial sense for the put option holder to sell the underlying asset at the strike price by exercising the put when it can be sold at higher price in the market. There is generally no advantage to exercising an at the money option for which the strike price equals to the market price of the underlying assets. And the money options are normally left to expire worthless. So this would be an example of an equity option quotation. You see there are many variables here. Here you see this company's name, XYZ Incorporated. You see the date, March, September, and December options, normally during the mid of the month. And then you see here, this is the price of the options. You see which are calls and puts with this 17.5, which is put. And you see with the P, letter P, that means is the put option. Here you see the bid and ask price. And you're going to, if you execute the order, if you want to buy the options, you are likely to get in the middle of the bid and ask. So this is the last trading and here the option volume, and also for our like the option interest, open interest. So here there are different. It's very important if you want to pick the right contract. You need to at least look and read the quotations. So explanation: XYZ Inc. the underlying equity for the option, and 1750 the closing market price of the underlying equity, which is right here on top of it. And March, the options expiration month, it could be March, September, December. It really depends on the option market liquidity. So today we talked about the first part of the option basic. So I thank you for watching. If you like my videos, please subscribe and give me a like button. And you have any questions, feel free to communicate with me, and I'll see you in the next one. Goodbye.